We're jumping straight into Founder Group today. Everyone is watching the price action. But the real story is the massive disconnect between their current trading volatility and their contract backlog.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this solar infrastructure play, make sure you hit the subscribe button and give us a like. We're here to simplify the market noise for you.
And there's a lot of noise with this one.
A ton, trust me.
Right.
It's been a chaotic week for this stock.
That is putting it mildly. I mean, if you've been watching the ticker, it feels less like a stock chart and more like, I don't know, an EKG during a heart attack.
It really does. So let's just set the scene for everyone, because the context is everything here. Today is February 11, 2026.
Right.
If you were watching Founder Group, say, over the last 48 hours, you probably got whiplash. We had a trading halt on Monday, February 9th.
Okay.
Then yesterday, February 10th, a massive corporate action went effective. A 100-for-1 share combination.
Which is just, a reverse stock split, a very, very aggressive one at that.
Right. And usually when a microcap halts trading and does a 100-for-1 reverse split, the market instinct is, well, it's pretty simple. You run away.
Oh, absolutely. It screams distress. It screams, we have to artificially prop up our share price just to stay listed on the NASDAQ.
It's the classic penny stock zone of death. You see this when a company has diluted everyone to oblivion, the price is, under $1, and they get that dreaded letter from the exchange.
They need a reset just to stay compliant. So let me just play devil's advocate right out of the gate here. Why are we even talking about this? Why isn't this just another distressed company circling the drain?
That's the perfect question. Because if you only looked at that chart, you would just ignore it. You'd write it off as a value trap, for sure.
Mm-hmm.
But the reason we're digging in is that beneath all that administrative mess, there is a fundamental story that is just completely at odds with the share price.
Okay.
We are looking at a backlog versus valuation disconnect that is, frankly, pretty rare to see.
All right. Define disconnect for me here. Because, a lot of companies claim they're undervalued.
Sure. Think of it this way. The market is treating the company like it's a shell, right? Because of the reverse split. But inside the company, they're sitting on signed, sealed infrastructure contracts worth hundreds of millions of dollars.
So the market is pricing in the fear, not the fundamentals.
Exactly. The fear of the corporate action, while totally ignoring the fact that the company just landed a project that is, 10 times its annual revenue?
That's a bold claim. When the gap is that big, there's usually a catch. So let's look at the numbers. What's the baseline we're working with?
The baseline is, it's pretty modest. Their last fiscal year revenue is sitting at roughly $19.75 million US.
Okay, which is tiny. I mean, in the energy infrastructure world, 19 million is a rounding error. It's a mom and pop shop number.
It is. And if that was the whole story, we wouldn't be having this conversation. But you have to look at the forward-looking book. They've secured a major contract for a solar project in Sarawak, Malaysia. Right.
This is a 310 megawatt peak solar plus storage project. The value is 1.16 billion Malaysian ringgit. So converted to USD, that's roughly $250 million.
Hold on a second. Let me just process that. They did under 20 million in revenue last year.
Yep.
And they just signed a single deal worth 250 million.
Correct. And that's not even all of it. They also have a separate $68 million contract for another 100 megawatt solar farm.
So we're looking at a backlog that is just exponentially larger than their entire trailing performance.
Yeah.
This is like a python trying to swallow a goat.
That's a perfect analogy. And that right there is the core of the bull case. The market is looking backward at the small revenue, at the messy chart. But the company is looking forward at a tidal wave of revenue if they can execute.
That "if" is doing a lot of heavy lifting in that sentence. We really need to break down what they actually do. Solar company is so broad. Where does Founder Group fit in?
They're an EPCC player. Let's unpack that acronym. The mechanics here really matter for cash flow and risk.
Sure. Engineering, procurement, construction, and commissioning. Basically, they're the general contractor. They're the builders.
Okay, so they don't make the panels, and they don't own the farm long term.
Exactly. They design it. They buy all the steel on the panels. That's procurement. They pour the concrete. They plug it into the grid.
Got it. So it's a service business, which is an important distinction. We're not talking about 90% software margins here. This is a capital-intensive game.
It is. It's a lower margin, high volume business.
Yeah.
But here's why they're interesting in Malaysia specifically. They focus on large-scale solar LSS and commercial rooftops.
And why does the geography matter so much? Why can't a big U.S. or European firm just fly in and build this?
Well, infrastructure is always political, you know that,
Hmm.
especially in Southeast Asia. You can't just parachute in. Founder Group has a really strong foothold in the state of Selangor. They've got the local history.
The local connections.
Right. And when the government is handing out these huge energy transition contracts, they tend to favor local champions.
Yeah.
They want the money to stay in the country.
So it's a bit of a regulatory moat. They're the guys on the ground who know how things work.
Exactly. But there's a second piece to this that I think is even more interesting, and it kind of addresses the margin issue you brought up. They're trying to move from being just builders to being, let's say, tech-enabled managers.
I saw this in the notes. They're talking about AI. And I have to be honest, whenever I hear a construction company start talking about AI, my buzzword detector starts flashing.
Fair enough.
Is it real or is it just for the PowerPoint deck?
No, it's actually a really legitimate application for this industry. They're using AI-powered drone inspections.
Okay, explain that. How does a drone actually save money on a solar farm?
Well, imagine a 300-acre solar farm in the middle of the tropics. Thousands of panels. Traditionally, inspecting that means sending guys out in trucks with handheld thermal cameras. It takes weeks.
It's slow, it's expensive.
Right. And human error is a big factor. If a guy misses one cracked panel, you're losing power generation. Founder Group uses drones with computer vision to scan the whole field in just a few hours. The AI finds microcracks, dust, hot spots, all the little things that kill efficiency.
So it's really about yield optimization.
Precisely. That tiny 3% difference between a farm running at 95% efficiency versus 98%, that's pure profit for the owner. If Founder Group can offer that monitoring as a service, they move from low-margin building to high-margin recurring revenue.
Okay, that does change the profile a bit. It gives them a long tail of revenue after the construction is done. It's much smarter than just building it and walking away.
Right. So, to sum up the bull case, you've got a company in the right place, ASEAN is booming, with the right government ties, holding a backlog 10 times its size, and it's using tech to try and boost its margins.
It sounds fantastic on paper, but my job is to be the skeptic here. Let's look at the other side of this. Because if everything was that perfect, the stock wouldn't have needed a 100-to-1 reverse split just to stay alive.
Agreed. Let's pivot to the bear case. This is absolutely not a risk-free trade.
Okay, let's start with the split itself. You said it was effective February 10th. Why do investors hate these so much? I mean, mathematically, my equity is the same. Why does the stock almost always dump afterwards?
It's all about the signal it sends. A reverse split is basically an admission that the market drove your price so low you were about to be delisted. It tells the world we are in distress.
And it's a magnet for short sellers.
A huge magnet. They know retail investors get spooked and sell, so they pile on and drive the price down even further. It becomes a self-fulfilling prophecy.
It also it has a stink to it. It signals that management failed to maintain value in the past, and that takes a long, long time to wash off.
It really does. But the bigger risk here, in my opinion, isn't just the chart. It's the David versus Goliath operational risk.
This goes back to a number I saw. Is it true they only have around 82 employees?
That's the reported figure, yeah.
Yeah.
Bet 82 people.
Okay, so let's just think about that. 82 people are supposed to manage a $250 million infrastructure project. That ratio is terrifying.
It is monumental. This is the execution risk, with a capital E and a capital R. Managing a project that size involves logistics, hundreds of subcontractors, supply chain.
And if they screw it up, if they're late.
There are massive penalties. They're called liquidated ascertained damages, or LADs. If you're late delivering power to the grid, you pay a penalty for every single day of delay. And those penalties can completely wipe out your profit margin.
So they could win this massive contract and still lose money on it if they mismanage the timeline.
Precisely. It is a huge scaling challenge.
Yeah.
Can they hire the right people fast enough? Can they secure the credit lines to buy all the materials before the client pays them?
That's the working capital trap. You have to pay for all the solar panels up front, but you might not get paid for 3 months until you hit a milestone. If you don't have the cash, you choke.
And their financials show a net loss for the last fiscal year, a negative $1.13 million. They are not sitting on a mountain of cash. They are burning cash just to grow.
Which means they probably need to raise money, which brings us right back to the stock. If they need to raise capital, any equity raise is going to be highly dilutive for current shareholders.
That's the vicious cycle. They need money to build the project that will bring in the revenue. But to get the money, they might have to sell more shares, which hurts the stock price. It's a very delicate balancing act.
So putting it bluntly,
Right.
you're not buying a stable utility here. You're buying a venture capital style bet that this management team can pull off a logistical miracle with a skeleton crew.
That's the perfect way to frame it.
Okay, so we've got the bull case, that huge backlog, and the bear case, the execution risk and dilution. For anyone listening who's interested, what are the specific signposts? What should we watch for in the next 30 days?
The most immediate thing is the resolution of that trading halt from February 9th. We need to see if there was any news attached to that, beyond just the split.
What kind of news would be good news?
Financing. If they announce a major credit facility or a partnership with a bank to fund that Sarawak project, that is a massive de-risking event.
Yeah.
That solves the working capital problem we just talked about.
That would be the green light.
Yeah.
It means a bank has done its due diligence and trusts them enough to lend against the contract.
Exactly. The second thing is the filings. Forget the press releases for a minute. We need to see the next 6K or annual report. We need to see customer deposits show up on the balance sheet. We need to see the cash actually hitting the books.
Show me the money. Words are cheap.
Exactly. And then specifically, any updates on that Sarawak project. Groundbreaking photos, announcements of key hires. If they announce they brought on a major engineering firm to help, that reduces the execution risk significantly.
And what about the macro picture?
Yeah, watch the broader industrial sector. We're seeing money rotate out of big tech and into real-world assets, infrastructure, energy manufacturing. If rates get cut, financing these big solar farms gets cheaper. If that tide keeps rising, Founder Group is a small boat that could get lifted with it.
It really feels like timing is everything. You have to be able to stomach the post-split volatility to even have a chance at seeing the fundamental story play out.
That's the trade. The next quarter, Q1 and Q2 of 2026, that is the prove-it period for them.
So before we wrap, can we just circle back to that tech angle for a second? The drones, is that their own proprietary tech, or are they just, buying them off the shelf? Because that's a big difference in value.
That's a great point. They're integrating it into their own platform, but they likely aren't building the drones themselves. The value isn't the hardware, it's the data analysis, the software layer that interprets what the drone sees.
So that's where a potential tech multiple would come from. If they can sell that data insight to other farm operators, they become a software company.
Right. If they only use it for themselves, it's just an efficiency tool. That distinction is key. Investors should watch if they ever license that tech out.
Got it. Okay, so let's bring it all home. What's the summary here?
Here is the lowdown. You have a microcap company that has been beaten down by market mechanics and a scary reverse split. But relative to its tiny market cap, it holds a contract backlog that is just massive. It's a high-risk, high-reward bet on the electrification of Southeast Asia.
It really is a binary outcome. Either they execute and the stock has to re-rate dramatically higher to catch up, or they fumble the execution and it all falls apart.
Precisely. And I'll leave you with this final thought. The market is efficient, but it's not all-knowing. It sees a reverse split and it runs away. It's a reflex. But just imagine fast-forwarding 6 months. If that Sarawak project is 30% complete and generating cash, the price action we're seeing today, this panic, it might look like a historic overreaction.
You're buying the fear, but you're getting the potential of the backlog for maybe pennies on the dollar.
You just have to have the stomach for it.
That's
The lowdown on Founder Group. Thanks for tuning in.
And don't forget to subscribe. We'll see you on the next one.